Hey everyone, hope you all had a great Christmas. So my present to you this year is this video, which hopefully helps you with 2018 on what to expect in the markets. I know many don't believe in fundamental analyses and just want to approach the charts from a technical viewpoint, but believe me, it's very useful if we can see behind these things. Well, interesting things are happening on the bond and interest markets, especially in Europe. Let's take a look at the German Bund. As we can see, the German 2-year state bonds yield has jumped to a 5-month high. Okay, now a quick look at the yield of the American 10-year state bonds. It had not been this high for the last 9 months, and all kinds of other European state bond yields are also at their highest since several months. I'll get to why this is important shortly. The raising of the American interest rate did not come as a surprise. I mentioned several times, but it seems that sooner or later, because of Europe's improving development in labor market data, the ECB, which is still behind, will definitely be compelled to modify its interest rate policy. In other words, they will raise interest rates. Market participants are increasingly starting to anticipate that the interest levels are not going to stay in the negative forever, and monetary expansion won't be here forever either. Especially if we start to see genuine signs of the unavoidable wage inflation. The interest deadlines for the European Euribor of 2020 December have fallen to a 5-month low point. Therefore, the expectations of the interest rates have jumped to a 5-month high. What does this tell you? That it makes perfect sense to expect a raise in interest rates next year. I think that this may be the start of a fresh trend. This year, interest levels have started to rise in several countries, and this may turn into an even wider progression in 2018. It might easily happen that yield increase starts to sneak into Europe as well. So from what I can tell, there might easily be problems in the bond market. And what does this mean? Well, if interest rates increase, the price of bonds drops. This is extremely bad for precious metals and isn't favorable for the stock markets either. Meanwhile, the euro is astoundingly strong, which is not surprising. The majority of the euro's short positions are still open, and the market always goes in the direction where it can cause the most people pain. If the interest expectations in Europe are indeed repriced, then this may also have an additional significant effect. All in all, it's a good idea to monitor several markets. So a couple of questions arise. First, is the ongoing European interest in yield increase wave really the start of a new trend? I think so. Second, if yes, this is very encouraging for the euro. Will it stay strong? I think so. Third, in this environment, what's going to happen to precious metals? A drop, definitely. Fourth, how does this affect the stock market? A correction may come into play, I think. We've done it ourselves and seen it happen elsewhere that quicker or smarter market participants start to build up their positions a couple of days before or after Christmas in order to prepare for next year's trends and to get ahead of others. So those that waited until January's first trading day were often too late to join in. I'm curious to see if this is the case now as well. Thanks a lot for tuning in. I hope you enjoyed the video. Until next time, take care and Happy New Year.